All right, folks, this is going to be a very short video. I'm going to talk about two different things here. One, the outline I gave you for the British pound last night, and how you can use the commentaries and how to study and give you an example, and also algorithmic theory in concert with what I've outlined in the chart. Now, it's important that if you go back and watch the video, you'll hear these things that I mentioned in the video. This is the reason why you must take notes. And I talk about specific things, times of the day, certain directional responses at specific levels. I have targets. I have things I'm looking for, but I'm also giving you prompts about what may unfold around specific levels. Okay, and I'll tell you what they were. If you've downloaded the video, you'll see by going back, nothing has been changed, nothing's been added to, nothing's been tweaked to make it sound perfect. So that way I can reach back to something and look good, okay? All right, so we are looking at a 5-minute chart, and some of you are probably thinking, man, 5 minutes, it's too small, I can't trade that. Well, in a market environment like we have right now, where everything is compressed, the daily ranges are not really moving outside of their present daily dealing range. So you have to work within these lower time frames to find the setups, but still precision exists here. All right, so I'm going to count you to go back to around the 1 hour and 6 minute mark to around the 1 hour and 8 minute mark, thereabouts. I was talking about the British pound and how it would likely reach down into its 15-minute time frame fair value gap, and should we get there, we'll probably get a pop. Okay, those are the words I gave you. I felt, and I still believe, that should the dollar turn around and we break higher out of its current daily dealing range, it's just consolidating. Okay, and we're going to see what we get on Friday's trading, but for now, just know that it's a very small, tight scalpers market. And if you can't scalp or trade intraday, it's best for you to stay on the sidelines. And this is predominantly what January is like. Okay, so I try to avoid these big breakout type long-term trend swing trading ideas, because that's generally not what you see in the month of January. All right, so we're looking at the 5-minute chart here, and I want you to take a look at this and think about what you see before I add annotations. If you're not ready, pause the video now. All right, so during Asia last night, we had the market trade back up into a fair value gap, into a bearish order block right here. We had a sell side liquidity pool here with the short-term low, and the market created this fair value gap, traded up into it, and traded softer, consolidated in at midnight last night, New York time. We had a little bit of a Judas swing here, and then we broke down. So we had initial displacement here, fair value gap. The market trades back up into, at the beginning of London open kill zone. That's 2 a.m. New York local time. So think about what I'm showing you here. Time, London open, starts right at the beginning. It's trading at a bearish order block after it completely balances in this sell side delivery. Okay, so in other words, this one single down candle gets rebalanced with up movement. Okay, think about that paint roller analogy. Every down move in the marketplace has to be balanced with an up move. That's efficient market delivery. Okay, so if the market trades back to this bearish order block here at 2 a.m. and it fills an imbalance, it's created an optimal trade entry, another level of displacement, and we have a mitigation block, which is this last down close candle. Why is that a mitigation block? Because we have a high, a low, a lower high, not high, low, higher high breaker. Notice it doesn't get up to that breaker level. So you have to know what you're looking for. Many times you're going to see mitigations form right on the other side of a breaker or a potential breaker. Then this becomes the more specific or sensitive level for institutional trading. So we have the mitigation block here. It trades up into it. Now this also is a optimal trade entry. for selling short, targeting the sell side liquidity. Now, is that all that you would be looking for? No. We do 10 pip, 15 pip, 20 pip, 25 pip, 30 pip, and as much as a 40 pip grade sweep below old lows or above old highs. Now, remember the 15-minute time frame fair value gap on cable, or the pair British pound versus US dollar. That's this area here, the fair value gap. Now, if it's going to reach down into that imbalance, you have to couple that with other things algorithmically. So what I've outlined here is what IPTA, Interbank Price Delivery Algorithm, was looking to do in here, and I'll cover all these points one at a time. So as a sample of algorithmic theory, the short-term premise or narrative was US dollar short-term bullish, pound dollar short-term bearish, bearish protraction to discount fair value gap. In other words, we're looking for it to trade down here. So IPTA will want to trade to this level. Proximal sell side liquidity pool, 20 pip grade. That means near term sell side liquidity pool, while it's up in here, near term is here. So the closest liquidity pool for sell side is here. And 20 pips down converges with the fair value gap that I've already outlined and pointed to last night. London Open trades to a bearish order block here and fair value gap premium array. That's right here at the beginning of London Open kill zone. So when you look at these little boxes here, I want you to think about the beginning of it here, think straight down, or if this box is ever underneath price, think of it as the beginning and look up to see where you are in the price action. So at the end of London Open kill zone here, then we're not concerned about it until we get to New York. Okay, so we have London Open bearish order block here and the top end of the fair value gap, which is a premium array. So we have the premium mitigation array here, and then the institutional order flow entry drill into premium mitigation array, which is here. Remember, we're looking for the single one candles that go one directional, where it begins and ends for that fair value gap, or in this case, it's a SIBI, sell side imbalance, buy side inefficiency. I don't have it on the chart because there's already too much here. And for new students, this is probably already causing your head to spin. But this is a taste of the things I'm teaching charter level members this year. Okay, so that kind of gives you how deep this goes and how specific and how precise and algorithmically price is delivered. It's not willy-nilly. It's not some kind of contrived, find some lipstick in a chart and look smart. I talked about these very things in yesterday's commentary. The things I'm going to talk about, go back and listen to the video and you'll hear these same things being talked about in yesterday's video. Now, I'm not specifically talking about these levels because they haven't formed yet, but we're looking for this level to be traded to. Okay. The grades on runs on stops, okay, or the sell stops that would be below here, it could be 10 pips. Well, what matches that with 10 pips below that? Is it the fair value gap? No. So you got to go down 20 pips. So it's a deep dive of 20 pips. It converges with the fair value gap. So right away, you have multiple things here lining up with price wanting to get down to this area here. All right. So this low doesn't come in exactly at 136.52 even. It comes in around 136.51 and something. Okay. And we always round up to the nearest whole number. Okay. So by doing that, it allows us to calibrate the levels relative to our chart, because there's always going to be some kind of disparity between each broker's live feed. So the way we compensate for that is we always round up when we're looking for lows, and we round down when we're looking for highs. Okay, so what I mean by that is, since this low actually went a little bit lower than this, I'm rounding up because it didn't get to 36.51 even. It was a little bit above 51, but it was below 52. So we round up to 52, and that's what's indicated here. 20 pips down below this low takes us to 136.32. Now it goes a little bit below that, but we're only talking about a pip or so. Now, if you're going to go crazy about not getting that absolute one single pip, because you're not going to get it anyway, because the spread's going to be a factor. But for your analysis sake, it's this precise. And it's blending multiple things, which is time and price. When you have this institutional order flow entry drill, which is another optimal trade entry, you anticipate another run down that takes us into the fair value gap. Now, once we do this, we have offset distribution under proximal lows. Now, proximal lows are from this low to high, and the setup that sells off in London. Where are the proximal lows? Okay, or near-term lows. This low, then this low forms as it retraces, and then when the market trades down, what are we doing? We're looking for reasons to take partial profits. Now, you could take partial profits here because the fair value cap could have not really been traded to. It could have avoided going down that low. And if you didn't take partials below this low over here, you could have potentially sat through a reversal and never taken profit. In other words, if you're looking for your absolute objective, which is what I outlined here as a possible sell side target, the fair value gap on the 15-minute time frame, this would have been a failure to reach that objective if you didn't take partials. But it sets up another sell in London and institutional order flow entry drill, which is just trading to this high or just above it. You can go short there. Then it sells off, trades below this short-term low. You want to take profits in here, and look what it does. It goes right down to the bottom end of that fair value gap, and look at the bounce. Pow! Right up into bearish order block, and one more dive below a short-term low, and this is, again, offset distribution. Offset distribution is you're offsetting your short position by distributing some of the position, if not all. So you're always taking profits below a short-term low in your short positions. Now, you don't have to do it at every single short-term low, and as you see here, there has to be some narrative as to why you would be looking to do it anyway. So we have the fair value gap that I outlined yesterday. We have 20 pips below this short-term low, and we're in London, and we've already had 1, 2, and then one more time, 3 times we pressed down, and we went below the fair value gap to the tune of 20 pips. So 136.52 minus 20 pips takes us to 136.32. So it's exactly 20 pips, not exactly from low to low, but it's close enough, and that's how we work with and calibrate the levels. Once we have offset distribution under 1, 2, now 3 times we press lower, and we're ending, see what's happening here? We're ending London open. So we're anticipating the market going in consolidation. If it is likely to go lower, we'll look for a New York setup to do so. But I also gave you something yesterday in the discussion, which was day of the week specific. When we are bearish, we anticipate Thursday capping the week around New York open. When we're bullish, we expect the week to be capped in New York open. Now, it can move a little bit more into Friday, but generally, if you use this rule of thumb, it will serve you exceedingly well. Thursdays is kind of like the last day for me. I like to take partials. I like to take all of my trade off if I can, unless there's something really sweet that it hasn't been reached to on Friday. I'll hold some piece of it on, but usually it's such a minute little that I may have started with earlier in the week. It's insignificant. So if it gets the objective, it really isn't making that big of a deal. It's more of a moral victory than anything else. So we have day of the week phenomenon, which is Thursday, which is a range limiter. And all that means is that the weekly range is many times limited by New York open on Thursday, only when it's directional. Okay, so if we've been thinking about a directional bias, in this case, we were looking for weaker prices on cable, higher prices on dollar. We traded into now the New York open, which we're setting up the likelihood of a market reversal profile in New York open. So I have a little bit more price action in here. This shows part of the New York open setup. Pause the video if you're not ready. Okay, so everything that I've outlined over here going into London, we have that 3 drives lower here below this sell side liquidity pool. The market runs higher above this short-term high right here. So we have a shift in market structure here, and the market drops back down. Look where it starts. At the beginning of the New York Open, 7 a.m. New York time, it creates this low here. And then we start consolidating ahead of what economic driver? I told you that we would have volatility. U.S. unemployment claims. It was released at 8:30 a.m. New York time today, or Thursday. If we look at this low to this high, isn't this an optimal trade entry? See that? So New York session on Thursday, when we have been bearish and we hit an objective down here, what's it likely to do? Well, it's likely to reverse, and we might get this pop that I mentioned in yesterday's video. Now, where could it go to? I didn't want to see it go to all-time new highs for the year. Okay, I wanted to see it give some kind of a tradable rally, but the breaker has been used, and we'll see this in the chart. It's been used as a reason to see cable keep going up into it. Okay, and I told you to go into your daily chart and find out what that level is for the daily breaker. I will show you exactly what it is in our weekend commentary, but for now, just know that I mentioned it, and it's in the discussion, and it's also in the chart. So if you look at what's shown here, we have a little bit more price data, and I'm just going to go right into the annotations, speed this video up. So we have a little bit more of a broader view of what's going on, and we have this short-term high over here. So we have buy-side liquidity resting above that, buy stops in other words. So everyone that's been trading short, their protected buy stop here on a fund level would be up here. They don't like to trail their stop loss real tight. And we have that shift in market structure here, optimal trade entry. U.S. unemployment claims report comes out right there at 8:30, and then we have the displacement higher, consolidation above here, and runs through the breaker. This is at daily breaker level. It runs through the buy side liquidity during London close, and in this level right here, okay, it's going to be the fib level. So we have the low to high. Here's your optimal trade entry in here. And what targets can you look for? Well, right away we start with the natural levels, which is the breaker, the old high, where there's buy side liquidity. And is there any fib converging with that? Well, we have a level here, but before the breaker, so that's not good. We have a level here that's above the breaker. That's pretty good. Then we have this old high, and nothing really lines up with that. So the next fib level is here. So as it consolidates, once it gets to this point here, I personally would not be in the market. You know, say this was like February, March, April. I would not be in here, and I would miss all this little bit of a move. Okay, but if you felt like you wanted to hold a small piece on, you can look for that 1.5 extension on a standard deviation of the range down here, just like I teach on the YouTube channel. And I know some of you are wanting to see the settings on this Fibonacci, so I'm going to give that to you in this weekend's review as well. I shared other places in the mentorship, but I know some of you are chomping at the bit, because now when you see things like this, you really want to know what these levels are and how to put them in your trading view Fibonacci. So this level here projected out in time, and look at the bodies respecting that here. So it's just a really nice delivery on the upside, certainly way more than I was anticipating. I felt that we could probably get up to the breaker, maybe fall short just by running above these relative equal highs and filling in this area here, but it just really pushed up higher, and very surprising. This is also one of the reasons why I don't like trading January, because I tend to be wrong more times than I'm not in this month. So it begs the question, if you know that this is a time when you, or in this case for myself, if this is when I'm not firing on all cylinders and my accuracy really falls off, I don't want to participate in this month a lot. But because I have to tell you what I think is going to happen, this is what you do. So what I've shown you here today is how you can outline studies. You can go back in hindsight, even if you can't watch it live, and flesh out price action moves like this. And again, go back and hear what I said. We're going to go down to this fair value gap. I felt that it could have went lower, but if it gets down to this level, we're going to get a pop. Now, in full disclosure, I was only thinking we would probably get up to this area here in this gap because it hadn't been up there yet. We went to this point here, didn't get to it here, in no time until here did it get back up into this area. So that would have been a reasonable level for me. If I would have been long going in here, that would have been enough for me. Like, I would have been content with that and then moved to the sidelines. But it's January, so I don't trade, and I've been making this very clear to everyone that's just started and everyone else that's been here for a while. You just know. All right, so that's going to be it for this discussion. It's just an example on how you can go in and use the things I'm talking about. If I'm calling a specific level, study these particular levels, because there's going to be tradable bounces, especially if I give you things like, you know, it can get a pop here, or if you can get a low resistance liquidity run, or if you get a tradable bounce. Those types of terminology is what I usually use for something that I personally would expect to trade or practice in. Or in case of hindsight, say you have a business or you have a job or you go to school and you can't watch it during that live market action, then go back into your charts and study it from a hindsight perspective, and you'll glean pseudo experience, but nonetheless experience. And finally, moving back out to a 15-minute time frame, this run here is on the heels of the low to high down to a discount, and that fair value got right there that I talked about last night. Okay, so my question to you is, had you not heard me talk about this particular level right in here, okay, that PD array, if I wouldn't have called that out to you and draw your attention to it, would you have expected this type of move today? I don't want you sending me an email, okay? I just want you to think about it. And when we get into better months, in other words, months that are more liquid, not January, not December, okay? Any other month, it's usually pretty liquid. There is a week that is Passover week. I just want to let you guys know that are new. I made a mental note before I started this because I wanted to say it the last time we talked yesterday, because there's a lot of new students now. I do not trade on Passover week. So while I'm not a Jew, I'm observing that week. It's spiritual to me, so therefore I don't personally trade. I only will give you lessons that particular week. Okay, so it won't be I'm going to call the market. I don't want to do that. So it's important to me that I get back to this. I've not been doing it for the last couple of years, and I'm upset about it because I tried to tell everybody before I was going to do this, and I still ended up doing analysis. So I don't want to do it. So this is my last one, and I want to go back to the way I used to do things, which would be honor that week, and I don't want to do any analysis. So you'll get pre-recorded lessons that week. So the midweek review and the weekend edition will just be price action lessons, not me thinking over top of charts saying what I think is going to happen. Okay, so just make sure you are aware of that. I'll remind you before we get close to that holiday again. And I think that's going to be it for now. I will catch up with you by way of our weekend review on Sunday. You'll get it Sunday morning, my time, anywhere between 10 o'clock and 11 o'clock in the morning. Just expect it around that time of day. It might be a little bit late. It might be a little bit early, depending upon what my schedule permits me to do, because I have to do a lot of editions of this video, and everybody's user group has a watermark that's different, and so I have to make the video multiple times every time I make a video. So it's a little bit daunting and it takes me more time to do it, but it is what it is. I have to do it for security reasons, because people are going to obviously going to try to share it or sell it, and then when I see it, it makes me easier for me to go through and find out who they are doing it and remove them from the mentorship. Last bit of business. Everyone's talking about the stock market and the GameStop stocks and BlackBerry stocks and AMC stocks and everything that's going on, how Robinhood brokerage stopped traders from being able to trade or buy in those stocks. In my opinion, I'm getting everybody prompting me, even in TradingView, they're sending me messages. Hey, what do you think about this? What do you think about that? What's going on? My short answer is look at my community tab, because I talked about it before today. Started trading. And I told you in a very short little funny made up myth, okay, or fairy tale about these hypothetical rich ogres. And the story was basically trying to communicate that the average Joes are never going to be able to come together as a group and then muscle the markets how smart money does it. And today was an example of that. It was ran roughshod on them, and that type of thing will increase if it continues. And all the folks that are trying to do this are setting themselves up for pain. And if it keeps happening, what will happen is, as a response, the watchdogs will enforce more leverage be placed on traders and more regulations. And that might be a good thing in some areas, but it might be a bad thing in others. Does it mean anything else? I think that this could potentially kick off a stock market crash. And it's this setting the stage for tomfoolery as an excuse why they sink the market. Because they got to have an excuse why Biden's administration isn't supporting the economy. It isn't doing things that would make the economy improve. And I know some of you are probably Democratic in here. I'm not a Biden supporter. I'm not a Trump supporter. I'm absolutely right down the middle. Okay, I didn't want either one of them. So I didn't vote in the 2016 election. I didn't vote in the 2020 election. But there has to be some kind of excuse as to why these things are going to happen, because Trump used the stock market throughout his entire term. Look at the stock market. Look at the stock market. The things that were in place for the stock market to go up and the companies to be profitable are not in place right now. So it's artificially being held up. It's heavily manipulated. And when you start seeing things like we're seeing now with these stocks and the public, John Q. Public, this entity isn't meant to make money as much as you want to believe it is. Okay. The stock market, the currency market, okay, they are Ponzi schemes. Okay, they're absolutely manipulated, just like lottery is. Okay, it's rigged. You're permitted to do a little bit here and there, but if you are going to do what they're trying to do, and they're trying to dress it up as, we're all going to bankrupt the billionaires. Listen, these people were not allowed to exit or buy their trades today at the high prices. But you can bet your rear end that the rich folks were getting out at those prices. And the story I gave today in my community tab was just to illustrate how, yeah, you might be a buyer and you might be willing to buy, but they're going to put such a wide spread when they start building that premium up in the price and keep offering higher, extremely wide gaps of price runs higher. All it takes is one share to trade there. Okay, like one transaction, and that market will print at that price. Now, once that happens, that allows traders with larger blocks of orders to sell theirs at that level. And then what you saw today was that cascade effect. But only the rich were allowed to get out of their positions today. And the folks on the street couldn't really do any of that. Not to the degree that the wealthy people did. So, long story short, when you're in chat rooms and you're talking about, yeah, we're going to do this collectively, we're going to do this, we're going to do this, like anything, that's going to get back to people that are in these seats, that are controlling these markets. And you don't think that they didn't buy those stocks up knowing if they reprice higher, everybody else is going to be like, yeah, we're making it go up. They keep repricing it and somebody buys it. And when they buy it, it prints to market. So that means you see it on your ticker. You see it in your chart. It really traded there. It doesn't mean these average people are pushing the price up there. They're being led to believe they're doing that. And then you saw today, only the rich, only the elite can get their portion out. And then you have the brokers messing with the traders saying, no, you can't be out. You have to hold yours. And that's a Ponzi. Okay, that's the definition of a Ponzi scheme. It's a pump and dump. And you have people like Tim Sykes. He's out there cheerleading. Yeah, we're never going to be able to. You're never going to stop us. It's going to continue. Well, they can stop it. Okay, they can absolutely stop it. And the way they can stop it is cause a market crash, do a 75 to 60% decline, and scare everybody and nobody will be doing it. And then once they're shocking them out of wanting to trade, it'll be back to just the big boys doing it again. So that's my opinion. That's all I got on it. I don't want to talk any more about it because those stocks, I never would have traded it anyway. Okay. So until I talk to you this weekend, be safe. I'll catch up with you by way of my community tab tomorrow, I'm sure, on my YouTube channel.